Welcome to The Explainer. Today, we are going to try and decode the rhythms of the stock market. You know those powerful forces that drive it from these soaring highs down to those gut-wrenching lows and then somehow all the way back again.
A lot of people look at the market's daily swings and just see chaos, random noise. But what if there's an underlying pattern? A cycle that, okay, it's not perfectly predictable, but what if it repeats itself? Let's dive into that.
So to really get a grip on this rhythm, we first got to learn the language. We'll start with the market's two main states, its two kind of personalities, the charging bull and the hibernating bear.
A bull market, that's that feeling of momentum, It's a time when stock prices are pretty much just going up, investor confidence is high, and the economy is usually humming along quite nicely.
And then you've got the opposite, a bear market. That's a serious, prolonged decline. The technical definition is a drop of 20% or more from recent highs. And during these times, pessimism just kind of takes over, and the whole economic outlook starts to look dim.
What's really wild is how these two markets are just perfect mirror opposites. The psychology is what drives everything else. In a bull market, you've got all this optimism, which leads to high demand for stocks because nobody wants to sell. In a bear market, fear takes the wheel, causing a rush to sell, and buyers are suddenly nowhere to be found. It's this incredible dance between feelings and finance.
And check this out. Here's some really valuable historical perspective. While bear markets can feel awful, the data shows they're usually much shorter. Looking back to 1942, the average bull market has lasted over 4 years. The average bear market, less than 1. The takeaway here is pretty clear. The good times have, historically, lasted way longer than the bad.
So what is it that powers these massive swings? Well, it's really this fascinating tug-of-war between two powerful engines. You've got the rational, data-driven economy on one side and our often irrational, emotional brains on the other.
Okay, and this is a really critical idea to get. The stock market is not a report card on how the economy is doing today. It's a prediction machine. It reflects what investors, as a group, expect the economy to look like, say, 3 to 12 months from now. It's always looking over the horizon.
A great way to visualize this whole thing is to think of it like the 4 seasons of the year. The market cycle doesn't just jump from good to bad. Nope, it progresses. It has its own spring of recovery, a summer of growth, an autumn where things slow down, and then a winter of recession.
Now, to put a finer point on that whole seasons idea, experts break it down into 4 stages. It starts with accumulation, that's the market's winter, when everything is quiet and smart money starts buying low. Then you get the markup, which is like spring and summer. That's the big bull run that gets everyone all excited. That's followed by distribution, or autumn, when the early buyers sense a peak and start to sell. And finally, you get the markdown, the bear market that follows as prices tumble.
And this really gets to the heart of that other engine. Economic data, it's just numbers on a page. It's our reaction to those numbers that creates the roller coaster. Our own psychological quirks often push us to do the exact opposite of what's logical, like buying high because of FOMO and selling low because we're scared.
Yeah, research in behavioral finance has actually identified these invisible forces, things like loss aversion, where the pain of losing $100 feels twice as bad as the pleasure of gaining $100, or herding, where we just follow the crowd, sometimes right off a cliff. These biases are what pour gasoline on the market's natural swings.
All right, so let's shift gears and look at the hard data. See how this all plays out over a century of market history. Because when you actually look at the numbers, some of the things we think we know about markets, they get turned completely upside down. For example, here's one you hear all the time. Stocks love it when the Federal Reserve keeps interest rates low. It makes borrowing cheap, it stimulates the economy. It's just good, right? But is that what the data actually shows?
Believe it or not, no. A 100-year analysis from a group called Quantpedia found the exact opposite. Stocks actually delivered the majority of their returns during periods when interest rates were going up. Now, why is that? Well, it's often because rates are rising in response to a strong growing economy, which, at the end of the day, is good for company profits. So, that leads to another huge and just as counterintuitive question. If rising rates aren't the big bad wolf, then when does the real damage happen? When do the biggest crashes actually occur?
And here's the twist. That same study found that the biggest market crashes happened after the Fed had already started cutting interest rates. Why? Well, think about it. The Fed usually starts cutting rates precisely because it sees economic trouble on the horizon. The rate cut isn't a magic pill that prevents the problem. It's a reaction to a problem that's already brewing.
Okay, so understanding the cycle is one thing, but actually navigating it, that's a whole other ballgame. Given all this complexity, what are some of the time-tested strategies for investors who are just trying to get through these market seasons?
Well, experts and seasoned investors tend to point back to just a few core principles. Things like dollar cost averaging, where you just invest a set amount on a regular basis that naturally makes you buy more when prices are cheap. Diversifying your investments, of course. Looking for great companies that are basically on sale during a bear market. And maybe the most important rule of all, keep your emotions in check.
I love this quote from an investor on Reddit. It just captures that value investing mindset so perfectly. A downturn isn't a reason to panic and sell the companies you believe in. It's a sale. It's a chance to buy more of something you already liked, just at a cheaper price. All of this really leads to one big takeaway. Trying to perfectly time the market, to predict the exact top and the exact bottom, it's pretty much a fool's errand for most of us. Historically, the most reliable path has been just staying invested for the long haul.
Look, at the end of the day, understanding the market cycle doesn't give you a crystal ball to predict the future. It's not about that. It gives you a map. And a map won't show you every single rock on the path, but it gives you context for the terrain. It lets you navigate with a strategy instead of with fear.
Because the next cycle, it is always coming. And while you can't predict exactly when it will arrive or what it's going to look like, the real question is, will you be prepared for it?